Assalamualaikum warahmatullahi wabarakatuh and good day everyone. Today I want to discuss on qualitative characteristics of financial information, accounting assumptions and accounting concepts. So, are you ready? Now let's start. First of all, this is the outline for our lecture today. I will break it into 3 different parts. We will start with the fundamental qualitative characteristics, followed by the enhancing characteristics, and we will end our lecture with the final part, which is the accounting assumptions and concepts. As an introduction, let's look at the conceptual framework. Initially, accounting incorporates bookkeeping and the preparation of financial statement. This process requires adherence to the qualitative characteristics of financial information, accounting assumptions, and accounting concepts in order to ensure objectivity and that everyone agrees with the treatment of the information. The conceptual framework of financial reporting issued by Malaysian Accounting Standard Board, or known as MSB, set out the concepts that underlie the preparations and presentation of financial information for external users. The purpose of conceptual framework is to guide the preparation and presentation of financial statements in accordance with the Malaysian Financial Reporting Standard Framework, or MFRS, or FRS framework. The qualitative characteristics is used to identify the types of information that are useful to the users of financial statements for making decisions about the reporting entity. In addition, the characteristics are applied to financial information provided in financial statements as well as to financial information provided in other ways. Financial information is useful if it has fundamental qualitative characteristics, and the usefulness of the financial information is enhanced by certain qualitative characteristics. In order to be useful to the users, financial information must be relevant and faithfully represent what it purports. The usefulness of financial information is then will be enhanced if it is comparable, verifiable, and timely as well as understandable. Okay fellas, now let's look at these fundamental qualitative characteristics of financial information. Now, by referring to the figure 2.1 in page 12 of your textbook, the fundamental qualitative characteristics consist of relevance and faithful representation. Information is relevant if it can make a difference to the decision making by the users of the information. This can be done if the information has predictive value or confirmatory value, or might be both. In addition, to be relevant, the financial information must be material. Refer table 2.1. Predictive value means the financial information can be used as an input by users to predict future outcomes and make their own forecasts. Whereas confirmatory values means the financial information provides feedback about previous evaluations. For example, let's say the financial information is about the sales of a business organization. Predictive value means the information about current year's sales can be used to forecast next year's sales. In other words, information on current year actual sales can be used to set the target for future sales. Whereby, confirmatory value means the current year sales can be compared with the forecast sales made in previous year to measure any differences for corrective measures or to improve the forecasting process. Materiality means if material information is omitted, misstated, or obscure, it could influence decision made by users. All business needs to specify the maturity level, as the maturity level depends on the nature of the information and its amount. Financial information must faithfully represent the substance of what it purports to represent. The information must complete, neutral, and free from error. Completeness here means all information that are necessary for users to understand their transactions being represented, including all necessary description and explanation. Neutrality. It means the financial information prepared is neutral or free from bias in terms of selection or presentation of financial information, and it is not manipulated to give favorable or unfavorable effects to the users. Free from error means the financial information have no material errors or omissions that the financial information able to give true and fair view of the reporting entity. Now we are in the second part of this lecture. After we learn the fundamental qualitative characteristics, we will now look at the enhancing qualitative characteristics. Now let's proceed. The first characteristic is comparability. Financial information will be more useful if it can be compared with similar info about other business and with similar information about the same business for another period or day. Comparability always been related with consistency. However, consistency refers to the use of same methods for same items over a period of time or in a single period across entities. To be comparable, financial information must be uniform. Means like things must look alike and different things must look different. Next will be verifiability. This means that the financial information must be able to be proven. It means different knowledgeable and independent parties could assure that a particular event is a factful representation. There are two methods on verification of financial information, namely direct and indirect verification. Direct verification means verifying transactions through direct observation, for example through physical stock count. Whereby, indirect verification means checking the inputs or model, formula or other technique and recalculating the output using the same method. The third characteristic will be timeliness. Timeliness means information is made available to decision makers in time to be capable of influencing their decisions. All the financial information is normally less useful. Lastly is understandability. Financial information is prepared for users who have a reasonable knowledge of business and economic events and who review and analyze the information diligently. Thus, the financial information should be presented in a way that are easily understandable. So, are you still with me, folks? Great! Now, we will look at the final part of the framework, which are accounting assumptions and accounting concepts. According to the framework, financial statements are normally prepared on the assumption that the business will continue its operation for the foreseeable future. In other words, the business is assumed to have an indefinite life and not expected to be dissolved in the near future. Apart from the qualitative characteristics and assumptions, accounting concepts should be applied in the preparation of the financial statements. One of the accounting concepts is historical cost. This concept requires business to record its assets, services, and liabilities at their original cost. This is because 1. Cost is definite and determinable. 2. Accountants can provide objective and verifiable data in their financial reports. And 3. Costs are measured on a cash or cash equivalent basis. Next concept is economic entity. This concept requires a business to be treated as separate and distinct from its owners. It means that items recorded in business books are limited to transactions affecting the business only and excluded the owner's personal transactions. Lastly, the money measurement concept. This concept requires that all business transactions are recorded in terms of money, that is, the currency of a country. This is because 1. Money is the common denominator. 2. Monetary unit provides an appropriate basis for accounting measurement and basis. And 3. Monetary unit is the most effective means of expressing changes in capital and exchanges of goods and services to the interested parties. That's all from me, ladies and gentlemen. If you have any questions, please do not hesitate to consult me later. Thank you for spending your time to watch this video. So see you again in our next lecture. Assalamualaikum and have a nice day.